Hello and welcome to the Rahul Nair Finance Show. You're listening to the monthly Dealroom, Markets and Startups, where we break down the key developments from the past month. Equity trends, sector movements, company updates, and startup funding. Crisp, clear, and to the point. Before we begin, here's a quick disclaimer. This podcast is for educational purposes only. It is not a buy or sell recommendation. Always consult a financial advisor before making investment decisions. Unpack exactly why 2025 was such a strange, divergent year for investors. Then we'll dive deep into the massive macro reset that really changed the rules. After that, we'll see how domestic capital became the hero of the story when foreign investors headed for the door, and why that sets us up for a much stronger 2026. And finally, we'll size up the key opportunities and, of course, the risks waiting on the horizon. Okay, let's kick things off with 2025. Now, this year, it wasn't really about those spectacular headline-grabbing returns. Nope. Think of it more as a year of consolidation, a fundamental reset, really. It was a period that, honestly, tested a lot of investors' patience and completely reshaped the rules of the game. I mean, if you just looked at the surface, things seemed pretty decent, right? The Nifty Sensex closed out the year with a gain of 9.1%. And hey, a positive number is a positive number. And you know, this wasn't just a fluke limited to the top 30 stocks. If you look at the broader BSE 100 index, yep, same story. It mirrored that performance exactly, also gaining 9.1%. So that suggests, a lot of stability at the top end of the market. But, and this is the crucial point, that headline number, it doesn't even begin to tell the whole story. And this right here, this brings us to the real theme of 2025, what I'm calling the Great Divergence. See, on one hand, you've got these positive numbers on the screen, but on the other, the actual experience for most folks, well, it was way more uneven, a lot more volatile. Those easy, broad-based rallies we got used to in the previous years, yeah, they were pretty much gone. This table really breaks down that lopsided experience perfectly. You see, the large caps, especially in safe haven sectors like financials and defensives, they held up pretty well. Mid caps, they saw some modest gains. But the real story, the one everyone was talking about, was in the small caps. After years of absolutely incredible performance, they took a meaningful hit. It was a classic case of valuations coming back down to earth. And what does that all mean? It means the market breadth. That's just the number of stocks actually going up. It narrowed a lot. The market started rewarding companies with solid, boring fundamentals over just a good story. Okay, so you're probably asking, what on earth caused this big shift? Well, it wasn't just about market sentiment changing on a whim. 2025 was the year of what we're calling the Great Macro Reset. We're talking about major structural changes that completely redefined the landscape for the Indian economy and, by extension, its markets. First up, let's talk geopolitics, because you couldn't ignore it. The trade relationship with the U.S. was a big question mark hanging over everything. Back in August, the U.S. slapped tariffs of up to 50% on some of our exports. Now, while negotiations were happening behind the scenes, the real story here, the one that really mattered, was India's own internal strength. Our domestic demand was so resilient, it acted like this powerful shock absorber. It really proved that India's growth engine is increasingly being driven from right here at home. But maybe the single most important thing that happened all year was the RBI's decisive pivot. They went all in on supporting growth. This timeline just lays it out so clearly. Look at that, 4 rate cuts, one after another, throughout the year. It brought the repo rate all the way down to 5.25%. That's a massive reduction of 125 basis points. This was the RBI sending a clear, powerful signal to the market. And how could the RBI be so aggressive? What gave them the confidence? Well, Governor Sanjay Malhotra summed it up perfectly himself. He called it a rare Goldilocks phase. And he was right. By October, CPI inflation had fallen to almost zero. That gave the central bank a ton of room to maneuver. They could slash rates to support the economy without worrying about stoking inflation. It was the best of both worlds. Now, it's important to remember, India wasn't doing this in a vacuum. The U.S. Federal Reserve was also in easing mode. They delivered their 3rd rate cut in December. This kind of synchronized global move, well, it was a major tailwind for us. It took a lot of the external pressure off, it helped our bond yields, and it dramatically improved the outlook for foreign capital to eventually find its way back. Okay, so this brings us to one of the most underappreciated, but honestly, one of the most critical shifts of 2025. I'm sure a lot of you were watching with some alarm when the rupee crossed that 90 per dollar mark. So the big question is, why did the RBI just let it happen? And the answer is so important. This wasn't a sign of weakness or economic stress. Far from it. This was a deliberate, strategic policy choice. The RBI basically shifted its whole currency strategy, moving away from a rigid defense of a certain level to a much more flexible approach. By letting the rupee find its natural level, it actually works as a better shock absorber for the economy. It gives our exports a boost, and maybe most importantly, it enhances India's long-term credibility with global investors. It shows we're more transparent and more market-linked. So, with all this macro chaos happening in the background, you might be wondering what was actually holding the market up. Well, let's go into the engine room and see how domestic capital and rock-solid fundamentals really took charge. It really came down to three things that anchored the market in 2025. First, corporate earnings held steady. Companies got really smart about protecting their margins and managing costs. Second, balance sheets across corporate India were still really healthy. We didn't see any systemic stress. And third, believe it or not, gold and silver had an incredible year. They hit record highs, acting as the perfect safe havens in portfolios. And that depreciation in the rupee we just talked about, well, that gave an extra little boost to Indian investors holding precious metals. But honestly, the biggest story of them all was this: the great flow divergence. This slide just captures it perfectly. You had foreign institutional investors, the FIIs, heading for the exits. They were selling because of global risk aversion and those high U.S. bond yields. But at the exact same time, you had domestic institutional investors, our DIIs, stepping in and buying everything up, powered by steady SIPs and long-term insurance money. And let's put some hard numbers on that. Foreign investors pulled out a massive 3.03 lakh crores from Indian stocks in 2025. I mean, that is a huge withdrawal. It was driven by global factors and, let's be honest, some good old-fashioned profit-taking after a great multi-year run. And yet, the market didn't collapse. It held its ground. Why? Because of this number. Our domestic institutions pumped in a record-shattering 7.81 lakh crore. They didn't just absorb all that foreign selling. They completely overwhelmed it. This, right here, illustrates the single most important structural shift of the year. Domestic capital is now the main stabilizing force for the Indian markets, period. And all of that brings us to what's next. After that big reset in 2025, the setup for 2026 is looking, well, a whole lot stronger and way more constructive. Let's take a look at why. I mean, the contrast with how 2025 started is just stark. For 2026, India's GDP growth is projected to be among the strongest in the entire world. Inflation is low, which gives the RBI plenty of flexibility to act if it needs to. Government policy is supportive, and with an expected recovery in the rural economy, you've got another layer of demand coming in. All the core ingredients for a strong year, they're right there. So, what does that translate to in terms of numbers? Well, the general consensus on the street is pretty positive. For 2026, analysts are penciling in a Nifty 50 target somewhere in the range of 28,300 to 30,000. And for the Sensex, we're looking at a range between 94,000 and 98,500. That implies some pretty healthy double-digit returns from where we are today. And here's the crucial part. This optimism isn't built on some speculative bubble or hype. It's grounded in real fundamentals. With corporate earnings expected to grow at a really solid 13 to 16%, the market can deliver these kinds of returns just by compounding those earnings. We don't need valuations to get crazy expensive again. And you know what? That is a much, much healthier foundation for any market up move. But of course, no outlook is ever complete without a balanced view, right? We have to look at both sides. So let's navigate the path forward by digging into the key opportunities and the risks we absolutely need to keep an eye on in 2026. Okay, on the opportunity side, the themes are pretty clear. With interest rates coming down, the rate-sensitive sectors, think real estate, think autos, they look pretty attractive. Financials like banks and NBFCs should do well with continued credit growth. And as the broader economy gets stronger, consumption recovery stocks are really well positioned. And finally, with the government's unwavering focus on capital expenditure, infrastructure is another really compelling theme. Now for the other side of the ledger, the risks. Most of them, you'll notice, are external. Any major volatility in global bond markets, or if the US Fed suddenly changes its tune, that could be a headwind. A sharp, unexpected U-turn in foreign flows is always a risk we have to consider. And we still need to be careful about pockets of overvaluation in some parts of the small and mid-cap space. And of course, the big unknown is always a major geopolitical shock or a new trade dispute. So to wrap this all up, what's the big takeaway here? 2025 was the year of the Great Reset.
It cleared the decks, it washed out the excess, and it laid a much stronger foundation. And as we look ahead, the message is pretty clear. 2026 is shaping up to be a year that rewards discipline, a selective approach, and good old-fashioned patience, rather than the kind of speculative frenzy that got left behind in 2025.
That wraps up last month's episode of the Rahul Nair Finance Show, brought to you under our monthly series, The Monthly Deal Room, Markets and Startups. If you enjoyed this episode, don't forget to like, subscribe, and share with your friends, colleagues, or anyone interested in business, investing, and startup trends. We'll catch you next month with more market and startup updates. Until then, stay curious, stay invested.